This is Behind the Headlines, with behind-the-scenes analysis on issues affecting Pennsylvanians, sponsored by the Susquehanna Valley Center for Public Policy. Now, here's your host.
Hi, from Philadelphia to Erie and from Pittsburgh to Scranton, it's Behind the Headlines. I'm Charlie Greenewalt, Senior Fellow of the Susquehanna Valley Center for Public Policy. And this week, I'm joined by the president of Susquehanna Valley Center, Ed Arnold, for an Arnold Report. And of course, with the Arnold Report, we ask the viewers, to set the program for us. You send in your questions to us, and we pose them to Ed. Questions about finance, investing, the economy. And he will use his experience, a lifetime of experience in the business community, and in his business, the trucking industry, which he dominated for years, to provide answers for us. So Ed, welcome to the Arnold Report.
Good to see you, Charlie.
It's good to see you too. Could you tell us about a new event that's occurring just south of Harrisburg? There were a lot of naysayers, a lot of people said it wouldn't happen, but lo and behold, it seems that 3 Mile Island, the remaining unit, is going to be opened, and it's going to be opened by Microsoft. Could you talk a little bit about that? What's happening?
It is quite amazing, the fact that Microsoft uses the power, it's equal to a 50, 60,000 population city to run their data centers. This is going to be exclusively for Microsoft that will run their data centers. And obviously the fact that it's going to cost literally tens of millions to reactivate it, and it is assuming all the permits are issued, it'll still be till 2024, probably 3/4 of the time is going to be required to get the permits. Mm-hmm. But basically, yes, it definitely will be. The data centers in this country at this point are going to use 8% of the power of this country. So we surely can't afford to shut down the coal power plants either. And we shouldn't shut down any atomic power plants.
Well, this is a reflection, isn't it, of this new artificial intelligence apparently requires, will require 20% of our nation's total electricity, according to some estimates that I've read.
Yeah. Oh, it is, unless they can have a new breakthrough in technology, which may happen, but at this point, we can't afford to have all this AI because our grids will not stand it. I mean, the good news is it'll crash first in California because their grid is under the most fragile condition right now because they shut their one of 2 atomic power plants, and each of their atomic power plants was 10% of their power. Mm-hmm. So therefore, California now is very fragile in their power structure. We're in Pennsylvania, we're in pretty good shape here.
Could be one of the reasons why Elon Musk moved from California. He's moving to Texas and in the process right now. So we'll see how that works out. Another viewer sends a question about Boeing, which once was one of the world's premier companies and one of the premier companies of America. This viewer asks you, how will the Starliner fiasco affect Boeing's stock and the company's overall value? I guess first, could you tell us what Starliner was?
The Starliner obviously is a space ship, for lack of a better way to put it. It's another term I'm sure they use. But anyway, that was going up to the space station to relieve some people. Unfortunately, because of, number one, it took like a month or 2 delays to try to work out all the failures on it. When it finally got there, they were so concerned about it that they would not let the people come back. Mm-hmm. So actually they sent a Musk SpaceX rocket up to get the people back. But they did send it back automatically, the space liner, yes. And it did survive. But they were so concerned because it had so many problems, which again is just a symptom of a company that has unbelievably quality problems. The debt in the company, which used to be $10 billion, is now $53 billion. The only reason it won't fail is because it's too big to fail and it's too important to America.
Airbus can't make all the planes in the world, can they?
Well, maybe the Chinese can.
No, hopefully. And that's...
they're trying.
Yeah,
and I'm sure we're helping them. Well,
yeah.
Boeing and Airbus both helped them.
Well, you had said a long time ago that once Boeing moved its corporate headquarters to Chicago, the business people were there and the aerospace people were back in Seattle, that dichotomy would spell a real problem down the line with the company, and it's all come true.
The new CEO is going to live in Seattle. They
that's
just fired
interesting.
they didn't fire him, they left him retire with a very generous pension. They should have fired him. Okay.
Okay, the third question, shifting gears from space to the suburbs. How does the decline of brick and mortar stores, especially shopping centers, affect our economic future? Can online shopping and brick and mortar stores survive together in the future?
They will obviously survive together, despite the fact that the overwhelming growth, which there's no question, online is growing more, but I have some interesting figures here. But really, what we're talking about is, here's the most interesting number. Online, and this is by categories of boomers, X, millennium, and Z. It was 22% of boomers only use online, 27% of X, 32% of millenniums, but then Z, it's back down to 28%. So really, it's leveled out as far as people pure online. What is growing is the hybrid model. The hybrid model is you order on the internet, pay internet prices, which may or may not be lower, especially Amazon, which is very deceptive, and then you pick it up at the store, which you just still have to have a store. So the stores are probably going to get smaller, but they will still be there. You can still go check. Instead of having made 20 sizes of a suit, they'll only have 1 or 2, and you can look at the suit. Or they won't have it in all the colors, so you can just try it on, but the color you want, you'll order it, and then they'll deliver it to you. Well, you'll pick it up. And it's very, actually, energy efficient, because truckloads will take the merchandise to the stores, and you will pick it up at the store and take it home, as opposed to direct delivery by UPS to your home.
Whatever happened to the whole idea? Remember, Amazon was going to have drones flying around the neighborhood delivering all the packages to our front door.
Well, supposedly they are in some rural areas delivering drugs. But it's going to, again, a drone's got to land somewhere, and you sure can't land in a condo. So basically, in your cities, it wouldn't work.
Okay. Next question from one of our viewers is, what do you believe is the best way to address our real or imaginary housing shortage?
First of all, it is a real shortage. Okay. And in my humble opinion, contrary to what anybody wants to know, let's say the Republicans are saying it's part of the cause. I think it's overwhelmingly the cause. We have in this country, we're now talking about 20 million illegals. Those 20 million illegals are occupying at least, because they do stick tenant a house or something, but that's still 2 million homes. So 2 million living units are now being consumed by illegals. And this idea, which both of, but specifically Kamala has said she's going to build 3 million houses. If you build 3 million houses, the price of raw materials, et cetera, and labor would soar. Plus, zoning locally won't allow it to happen. So we blame the federal government. The government, a lot of our things, our problems, are our local government regulations.
Well, moving on, question number 5 from our viewers is, this has been in the news now and again. Why has the Dollar General store stock lost value, and why are their stores being criticized by some municipal leaders?
Well, number one, its stock is very simple. The stock reacts to earnings. Their earnings dropped 30%. The stock dropped 35%. So that's how, and actually over the last 5 years or more, their earnings haven't particularly gone up. So therefore, there's no real reason for the stock to do well. But basically, when their earnings drop that hard, and the other thing, there has been articles, I don't know, all I can say is it's articles, that they aren't maintaining some of their stores and they're sort of crummy. So basically, that's the other thing. The company's reputation is not exactly stellar.
I guess there are some municipal leaders, too, who claim that they are concerned that they are the only, become the only source of goods and services, food and clothing for the local people, and the other places are run out of business in the downtown areas.
Yeah.
It's an interesting evolution of shopping, that's for sure. Ed, what should this, last question before the break, what should our state government be doing now to improve our state's economy? Is it actually happening now, or is it not?
Well, first of all, Pennsylvania has a reputation, and it's a well-earned reputation, with all its regulations and et cetera, that it's not business friendly. And part of that, it puts its money where its mouth is. We're one of the few states that has a capital stock tax on business, plus an 8.49% corporate income tax, which is one of the highest in the country. California is 8.8, so when you're almost as high as California, that's pretty bad. The only one that's really way higher, Minnesota, ironically, our president's state, is 9.8. They are the highest corporate tax in the country, but they don't have a capital stock tax.
Okay. Well, thank you, Ed. Let's take a break, and we'll be right back for the second portion of Behind the Headlines. Stay tuned.
Behind the Headlines is brought to you as a public service by the Pennsylvania State Association of Township Supervisors, the largest, most influential municipal association in the Commonwealth. Since 1921, PSATS has been preserving and strengthening township government and securing greater visibility and involvement for townships in the state and federal political arenas. Covering 95% of Pennsylvania's land mass, townships represent 5.5 million residents, more than any other type of political subdivision in Pennsylvania. Additional underwriting provided by the Worrell Corporation Foundation, based in Carlisle, Pennsylvania, by the Edward H. and Jeannie Arnold Foundation, and by the Pennsylvania Manufacturers Association. Business in Pennsylvania is our business. Behind the Headlines is also supported as a public service by the Pennsylvania Highway Information Association, the go-to source to learn about transportation projects and issues. Visit pahighwayinfo.org.
Welcome back to Behind the Headlines. I'm Charlie Greenwald, and I'm here today with Mr. Ed Arnold, the president of Susquehanna Valley Center for Public Policy, and we are doing another Arnold Report. And we are halfway through. We're at question number 7, Ed. This viewer would like to know, do you believe the idea that your total investments should not be more than 10 to 20% of all your resources?
The answer is absolutely no, because one size does not fit all. It depends upon your age, your mix of actually your assets you own, your estate planning, your risk tolerance. There's so many variables that each person has to work with an individual advisor, or basically just have come with his family or whatever, discuss. But really, it totally depends, therefore, on your situation.
Okay. Here, switching gears again in terms of economic areas. This viewer writes that, I believe that one of the best investments for the future is agriculture, since everyone will always need to eat. What is the best way currently to invest in agriculture?
Well, to my surprise, I agree with you. Very frankly, if you're a farmer and you just own farmland for a long time, it's the most steady appreciating asset there is. But since you aren't probably going to buy a farm, the other alternatives, actually there is a way you can buy pieces of farm. There are 2 funds. One's called Farmer Funder and the other is called Farm Together, where you can actually buy a small piece of a farm. Now, exactly how their performance is, I believe it's pretty good. They have very limited offerings. The one right now, I don't believe has anything that it's available. They develop them, and they buy a farm, and then they sell pieces off. So basically, that's one area. The other thing is there are a series of ETFs, and I'm not even going to actually give you their names.
Now, again, an ETF is a
exchange-traded fund.
Okay, thank you.
Which means you own a whole bunch of the assets in a particular class. In this case, agriculture, the commodities, the manufacturers, whatever the case might be, that would support farming or their results. However, when I looked at the results of these, 3 out of 4 have done very poorly. So at this point, I was amazed. I would have thought they would have done fine, but most of the information is a 5-year track record, and the 5-year track record, specifically the one recommended by Motley Fools, 4 out of 5 had double-digit losses over the last 5 years. Only one did well, and there was another one that had one that did very well, but the other 2 did poorly. So really, you could talk to financial advisors to see if maybe you're lucky enough to find one of the good ones, but overall, it's a great idea, and I agree with you, but it's very difficult to find a sound investment.
Okay. Well, another viewer writes in to you, Ed. Will political gamesmanship kill the fossil fuel industry and harm our nation's economy for the foreseeable future?
Well, that's a really simple one. If you elect the Democrats, yes, we will destroy our fossil fuel industry and we'll bring America to its knees. If you elect the Republicans, obviously they're going to encourage drilling, which is the greatest single asset America has.
And natural gas, fossil fuel.
Natural gas, well, fossil fuel, but basically natural gas. But even, and our natural gas, as a little tidbit, happens to be a lot cleaner than Russia's natural gas. We have exceptionally clean natural gas. And fracking, also, that oil is so clean you almost don't have to refine it. In fact, one of the problems is our refineries are designed to do dirtier oil. So we need some foreign oil to bring in, Mexico or wherever, where it's dirtier oil, to mix with our clean oil so the refineries work properly.
Oh my goodness.
So we not only do we have the cleanest and best of the carbons.
Okay. Well, the 10th question we have for you, Ed, for the Arnold Report this week is, how do micro E-mini future contracts for the U.S. stock market indexes, how do they work?
Well, very frankly, my answer is, I did some research. I talked to my financial advisor too, and we both agree there's such a high risk that I'm not even going to bother to try to explain it to you, because my stance is you shouldn't even consider them. They are just basically, the next subject we're going to have here is options. If you want to have a higher risk, higher return thing, you have options, which we'll explain in a minute. They would work fine, and they're very common. This is not, in my opinion, a good place to invest your money.
Folks, this is an answer we've never received from Mr. Arnold before, that this is such a volatile area, he doesn't even want to talk about it. So we respect that, and thank you very much for warning us about that, Ed. The next contract is, as you said, number 11 is, would you please explain futures trading to me, writes one of our viewers.
Well, basically futures, first of all, they're calls and puts. Now, there's two different kinds too. But basically a call, you're optimistic. You believe that, or somebody's optimistic, let's put it that way. When you buy a call, you're saying, I want the right to buy a stock at a price higher than it is today. So taking a simple example, and this is by no means, I'm probably getting a greater premium just to use round numbers. If you had a stock at $100 and you said you buy January calls, most of them are from 3, 6, 9, 12 months. There are some go out years, but the majority, and you've got to realize that puts and calls, which is the other side we'll talk about in a minute, don't trade a lot. And therefore a lot of stocks have them, but like all transactions, you have to have a buyer and a seller. So if you say, gee, I want to buy a call on a particular stock, if nobody wants to sell one, there's no transaction. Or the spread, the price, again, it pushes it up. But generally, just because of the way the market is, they're generally not very active, or there's certain ones. Maybe the 6 month 120 is active, but there's no 110s for 3 months. They're just, nobody's trading them. So basically, despite the fact you have all these different time frames and all these different, and they have different prices too, that you could have, a lot of times it starts at maybe a 10% premium where the stock is, but as time moves on, of course that gets in or out of the money and so on. But, so basically what you have here is, if this is the lowest risk in one ways, but in higher risk in the fact that you limit your loss. And that is, if you buy a call which says you have the right, this stock is at $100 a share, you have a right in January to buy it at 120. So it's got to go up to at least 120 to make the option worth anything. So from 0 to 120, if by January it doesn't do anything, you just lost all your money. Vice versa, if the stock went to 130, now that option would be worth $10, you only paid $5 for it, you'd have doubled your money. So basically speaking, it is, yes, you're risking all your money, but you could have a tremendous return. Vice versa, for the other side is a covered call. You own a stock. Well, you don't really want to sell it, but if somebody wants to give me $120 for my $100 stock, and they want to give me $5 for the right to do it, So if it does go to 120, which I now must give it to them at 120, but I've gotten actually 125 of the stock. So therefore, basically, that is a covered call. And now you can, so basically, when you own a stock and sell against it. So therefore, the other is you don't own the stock and you buy it. And the same thing can reverse for puts. Puts is you expect the stock to go down. What you're trying to do is the stock is again at 100, and you're saying, well, if it really crashes, like we've talked, the market could drop 50%, well, there's a risk your stock that's at 100 could drop to 50. So you sell an option that's at 80. Well, now you're going to say is, you must buy my stock at 80. Now I'm going to spend $5 to get this, so it's costing me money. But now I'm now guaranteed I can only take actually a $25 loss on my stock as opposed to a potential 50. And so that you, at the person, but if you are doing this naked, which means you don't own the stock, you're saying you will buy it at 80. So if it goes to 50, you're still going to do it at 80. There's a $30 loss in there. Okay. So basically, it is a way of, for a small amount of money, you can put a lot of dollars in play because you're playing with the whole stock, but you're only paying for the option. Okay. But you can lose all your money, or you can increase it. Because if the stock doesn't do what the options gives you the right to do, it's worthless.
Okay. Well, another viewer writes, as I try to make investments, how do I value a company? What is the intrinsic value of a company versus a relative evaluation of a company?
Well, those are interesting words. I looked up the definition of those two words. But basically, the thing very simply is, I guess you could say the relative value is, how does a company in this particular situation, let's assume that you're in the utility business. Well, stocks are better one of the oil industry. The oil industry stocks always sell for around 10 times earnings or so. It's basically a risky business because it's a commodity business. So indirectly, I don't care how well you run the country, the price of oil goes up, you make more money. If the price of oil goes down, you make less money. And that, generally speaking. So therefore, because right now, especially with our government constantly attacking the oil companies, the premium in oil, so that industry is 9 to 10 is the PE, price earnings ratio.
Okay.
So basically, if you had a particular oil stock that is selling for 12, that's not in its relative value. It should be from 9 and 10 times earnings. Now you could say, well, there's other items. Yes, there's book value, which is probably the least important. An asset you earn, it's what it earns for you. It's not what it's worth. I mean, if you say, I'm going to buy an apartment, well, that apartment value is, what can you rent it for? I don't care how much it costs to build. I don't care whatever. Basically, is if it's an income investment, it's its return. Well, indirectly, stocks, if they even don't pay a dividend, that's another thing. If they pay a dividend, that's a factor. Now, is the dividend growing? Is the history of the stock? If this company shows that it's basically growing about 10% a year, that's getting back to now this other value, is the value is the growth of the history of a company. Its history of its dividend, which is constantly being increased. What is the dividend? How well is the dividend covered? Which means if you pay a dividend of $1 and you earn $2, the dividend's covered pretty well. If you're only earning the $1.10, that dividend's a little shaky. If your earnings drops, the dividend could be cut, which some companies do. Now, also, some companies also have it. They pay a basic dividend, and then they pay a percentage of increase in earnings in a given year, a bonus dividend. But again, you put that all in the value calculation. But the biggest thing is, like right now, technology is going wild. And technology stops, sell it away premium. Why? Because they're expected to grow. I mean, right now, I'm going to say you're average, but if you were to take a bunch of peers, this, as I said, utilities, you'd expect them to grow maybe at 5% a year. So therefore, your multiple would be more like 10, or the oil companies and so on. They don't grow. They go up and down, but really overall growth is not that great. So therefore, your PE, your value, is really, still comes down to what is the future of the company's earnings. Because in theory, as they earn more, eventually they'll pay a dividend. All stocks don't pay a dividend because they keep plowing the money back in to grow faster. So there's different, again, different kinds of companies. But if you're saying, gee, I have a company here that its past track record is, and Nvidia, which I'm probably mispronouncing, I have trouble with that word, that stock is going up 1,000%. But the earnings have gone up phenomenal. It makes the absolute, dominates the market in an AI chips. It used to be for computer games, and now it's going into the AI market. And for some reason, they make, I mean, chips are unbelievably complicated. I mean, you've got 10,000 things can take place on the pinhead. I mean, it's mind-boggling how they're made. It is ironic, though, the company, in this case, and a lot of the companies, that's one of our problems, all the sophisticated chips, they're made in Taiwan. Mm-hmm. We make other stuff. We make memory chips, we make this kind of chip and that kind of chip, different companies. But even our successful companies like this one, that their most sophisticated chips tend to be made, which is another reason if Taiwan falls to China, that's really going to be a problem. But overall, that this value thing is based upon the expectations and the comparative to your peers.
Ed, in the last 30 seconds of our program today, maybe you could answer one final question, and a short one. One viewer would like to know, what is beta in the world of investment?
Well, beta is risk, the volatility. Beta 1 is the S&P. So if
Standard & Poor's.
If the Standard & Poor's moves at 5% and you move at 10% up or down, you have a more volatile than the S&P. If you were a utility stock, you may only move at 2% when it moves at 5%. You have a very low beta. You have actually a negative beta compared to the S&P. Beta is strictly volatility. How much does the stock move? All of these stocks I just talked about in the computer business, they tend to move very volatile. They might go up 100%, but they might drop 20% too. So therefore, you're looking at that's just simply it's volatility, and therefore volatility indirectly is risk.
Okay. Well, we want to thank you very much for being with us again this week. For another Arnold Report. And we ask all of you viewers out there, if you have questions in the world of economics and finance and investing, please send them in to us at the email that's below on the screen. And we'll give those to Mr. Arnold, and we'll talk about those then in a forthcoming episode. We want to thank you all for being with us this week, and hope that you'll dial in again next week for another edition of Behind the Headlines. We'll see you then.